Let's bring on board someone who's got decades of managing public money, Marsha Gordon, Vice President and Head of Emerging Market Equities with PIMCO. Marsha, good morning. Thank you for joining us. Within PIMCO and within your funds, are you experiencing outflows from emerging market dedicated products and some kind of an inflows into developed DM funds? And what has been your experience with money allocations across all asset classes, and are investors convinced about US economic recovery?
Well, our equity business is growing, and we have not had the same prominent effect of the switchover from the developed market equities into EM equities as have been seen elsewhere in the fund flow data. However, clearly the U.S. growth has been showing leadership. EM has been going through a number of transitional issues, and that manifests itself in shifting investor interest.
Marsha, hi. So what assumptions are you making on the Fed's proposed actions over the next 6 months and how that may impact emerging market investments?
Well, clearly the level of rates that we have seen at the beginning of the year has been very, very low, and it was logical to expect some gradual rise in expectations as we have witnessed in May and June. We view the tapering as something that will happen over 18 to 24 months basis. Clearly markets could fast forward that. Any talk of tapering, particularly if it becomes disorderly because of the number of carry trades that may have been put on in the market, could have a pretty negative impact on the dynamics of flows in EM. And if you were to take some emerging market countries like Turkey, like Indonesia, that had a number of macro imbalances and have been dependent on the fixed income, foreign fixed income flows in financing the deficits, those countries are clearly becoming very vulnerable. Now, a lot of that has been factored in by pretty violent market reaction there. We've seen the EM currencies weakening pretty rapidly in the second quarter. So I would argue that the markets have positioned themselves for gradual tapering, and now all eyes will be on whether there is a handover between financial assisted growth and the genuine self-perpetuating growth in the United States and elsewhere in the world.
Marsha, at PIMCO, the view is that we could enter into a recession in next 5 years. So where are you placing your investment calls, given that that is your broad call or broad view?
Well, look, that view is predicated on a number of unresolved structural issues. We are not out of the woods in Europe. Look, last year it was Greece, this year it's Portugal. Clearly we have a number of demographic issues as well as issues of leverage that are very much unresolved. So a recession is not out of a realm of possibilities over the next 5 years. So what do? It's more a question of what you don't own. You probably don't own mispriced credit. You do not own mispriced, richly priced high yield. So it is a question of moderating your positions in areas that are vulnerable relative to what default risk the price may be factoring in.
So have you increased allocations on cash or option strategies or bought dollars to mitigate currency risk and the sell-off in emerging markets?
I wouldn't call it a mitigation of the currency risk because we can do it through a forward instruments or other currency positions. But I would say that we have taken money off the table in April and May in a number of stocks, say in Indonesia, where we felt that the risk reward wasn't very attractive, particularly given a potential for a withdrawal of funds in the fixed income market that in fact then triggered equity retracement.
But you have been underweight on India for a while. Has the risk of Indian market has gone up or gone down in the last 6 months, and how do you foresee risk-adjusted returns for India over the next 6 months?
We have closed somewhat our underweight through the purchase of banks, private sector banks. We use the market weakness as times to accumulate. We do think that private sector banks are well positioned to eventually benefit from a pickup in investment growth. Again, we do not think that India growth story is broken. It needs time. Clearly the biggest worry for us has been currency. India, unfortunately, doesn't have huge elasticity of exports to currency, nor the elasticity of diminishing imports. So, unfortunately, weakening rupee is not having as much of a beneficial effect as it would, say, in a commodity-producing nation. So we continue to look for opportunities. Again, we wouldn't buy India Inc. Wholesale, but we do think that the market sell-offs provide attractive entry points in a number of securities that still stand for secular growth.
Right, but Indian markets have been in a range broadly between 5,500 and 6,100 on the Nifty. Do you think we are likely to move in a range for an extended period of time?
It's difficult to see the market breaking without rupee stabilization. Look, foreign investors ultimately are dollar investors, and having lost some 10% this year in currency devaluation, would make anyone pause. Now, the good news is currency is much weaker. The question mark remains when would investor community feel that the fundamentals match the price. And again, I think it's a question mark of the resumption of growth, resumption of investment activity, and more structural measures being put through. But again, we should not lose the sight of the things that have been done by the finance ministry, and a number of structural reforms in FDI, in telcos, in retail that have been championed in a relatively short period of time. So should that pace of structural reforms continue and elections, so to speak, be done with, I think Indian markets have a good chance of breaking out.
So what did you make of the fall in the rupee, that's the Indian currency, and do you hope to see, or rather what do you hope to see when it comes to the macro front in India?
Again, the fall in the rupee is very much a function of stronger U.S. dollar. With the move in treasuries, U.S. dollar yields, quite attractively relative to the remainder of the EM universe. EMs have been a source of the carry trade. Cheap financing clearly allowed multiple leverage there, and we've seen the unwind of that trade. Again, hopefully the yields that are now pretty compelling in emerging universe, coupled with structural reform and pristine policy making, could help stabilize certain EM currencies. So we are perhaps more positive on, say, Mexican peso versus Brazilian real. But again, it is very much also the function of the strength of the U.S. dollar.
Masha, there is also pressure on state-owned banks in India to cut lending rates, and the stocks have fallen there. Do you still see that there is very little merit in buying into Indian private banks, even though they are looking attractive?
It all very much depends on the degree the state uses these companies as a supplement or as a tool for stimulating growth. We are not very hopeful on that front, and particularly in institutions that are levered, that have capital adequacy requirements. That type of game is very dangerous indeed. In the meantime, clearly, private sector banks are more expensive, but think about the compounding effect. If you can avoid the landmine of NPLs, the compounding of the book value through the profit accretion is very powerful. So I would not be going for value within financials, particularly when the growth trajectory still remains quite uncertain.
So with the gas price hike recently, there has been a changed view on Reliance as well as ONGC. Are you looking at these stocks and the energy space favorably now?
Sure, this is a big deal, and again, this is a big deal not just in India. We've seen, interestingly, a similar deregulation happening in China at the same time. For us, it's a question of price. We currently do not own Reliance Industries. or ONGC for that matter, because again, we have been able to find better alternatives in global energy space. But it's certainly and surely a step in the right direction because it allows companies to accelerate the investment growth. I've seen some reports of Reliance becoming a big player in shale. Again, the economics needs to work here, but this is clearly a very positive thing for a potential for re-rating of the stocks in the energy stable.
Right, Masha, appreciate your time and thank you for your wonderful insights.